Hello and welcome. We hear about interest rates all the time, right? On the news, when we're looking at a mortgage, even just in our savings accounts. But have you ever stopped to wonder what actually sets those numbers? Well, today we're going to pull back the curtain and uncover the hidden forces that determine those rates we see every single day. Let's get started and crack this code.
I want you to think about it like this. What if there was a secret code that controlled almost everything? A code that dictates how much you pay for your house, how much your savings grow, and even sends signals about the health of the entire economy. Well, that code is the interest rate. And in the next few minutes, we are going to crack it wide open together.
All right, so to get started, we need to shift how we think about interest rates. Try not to see it as just some percentage on a screen. Instead, think of it as a price. To be specific, it's the price of money itself.
And this brings us to a really core idea in economics called the loanable funds theory. Now, I know it sounds a little academic, but the concept is actually super simple. It just says that the interest rate, the price of borrowing money, is set by the classic old-school forces of supply and demand. That's it.
So let's break that down. Who's on the supply side? Who's got the money to lend out? Well, it's anyone with extra cash they're looking to save or invest. And the biggest group by far is households. That's you, me, all of us putting money away. But it's also big companies with extra profits, governments that happen to have a surplus, and of course, investors from other countries.
And on the flip side, who's demanding all that money? Who wants to borrow it? Well, you'll probably recognize this list. It's pretty much the same groups. It's households taking out a mortgage for a new home, businesses borrowing to expand and build new things, and governments borrowing when they're spending more than they take in. It's this huge, interconnected marketplace.
And here you can see how it all works, the basic mechanics of it. Think about it. If the interest rate goes up, you're way more likely to save your money to get that sweet, higher return, right? So the supply of loanable funds goes up. But at the same time, borrowing just got more expensive, so fewer people want to do it. Demand falls. The interest rate just naturally finds that sweet spot, that equilibrium, right where those two forces balance out.
Okay, but you knew it couldn't be that simple. Of course not. There's a major curveball we have to account for, the fact that the value of money itself is always changing. So let's move on and add the next layer to our code, the inflation effect.
This is the one question that keeps every lender up at night. I mean, imagine you lend a friend $100. You're not just expecting $100 back next year. You're expecting that money to be able to buy the same amount of stuff. But what if it can't? This whole problem has a name you've definitely heard before: inflation.
Right, so inflation is basically this slow, silent erosion of your money's buying power. As prices for everything go up over time, every single dollar you have buys a little bit less. And you can bet that lenders are paying very close attention to this, and they need to protect themselves from it.
This difference between the sticker price rate and what you're really earning is captured by something called the Fisher effect. You've got the nominal rate. That's the number the bank advertises, the one you see on the screen. But then you have the real rate, and that's the one that truly matters. It's your actual increase in purchasing power after you strip out the effects of inflation.
And this simple little formula really says it all. If a lender wants to make a real return of, say, 2%, but they think inflation is going to be 3%, well, they have to charge a nominal rate of 5%. They have to. Otherwise, inflation would literally eat up all their profit and then some.
Okay, so we've got supply and demand setting the base price, we've adjusted for inflation, but there's one more huge factor we have to bake into our calculation: the simple human element of uncertainty. In other words, risk.
See, lenders aren't just worried about inflation, they're also worried about something a lot more basic. What if they just don't get their money back at all? That's called default risk. And they also worry about liquidity risk, like how hard would it be to sell your loan to another investor if they suddenly needed the cash? To take on all these what-ifs, they demand a little extra compensation, and that's called a risk premium.
And the relationship here is as simple and direct as it gets. The more risk a lender thinks they're taking on with a borrower, the higher the interest rate they're going to charge. It's just that simple. And that's exactly why a super safe government bond has a way lower interest rate than, say, a personal loan or a loan to a brand new startup.
So we've covered the base price, inflation, and risk. We are almost there. Now it's time for the final and maybe the most fascinating piece of this whole puzzle: time itself. How does the length of a loan change its interest rate?
This whole relationship is visualized in something you may have heard of called the yield curve. It sounds fancy, but really it's just a graph. It plots the interest rates of different loans against how long they last, all the way from short-term loans that are just a few months long to long-term ones that last 20 or even 30 years. And believe me, the shape of this curve tells a story.
So most of the time, the curve slopes upward. And this just makes intuitive sense, right? Lending your money out for 30 years is obviously riskier and ties up your cash for way longer than lending it for just 3 months, so you demand a higher rate. A normal upward sloping curve like this usually means the market is feeling pretty good, expecting a healthy, growing economy.
But sometimes the curve starts to flatten out. That gap between the short-term and long-term rates gets really small. This is a big sign of uncertainty. It's like the market is shrugging its shoulders, not really sure what's coming next, and investors are getting a little nervous about betting on the long-term future.
And then there's this one, the one that makes all the headlines, an inverted yield curve. This is when, crazily enough, short-term rates are actually higher than long-term rates. This is a rare and very powerful signal. It means the market is expecting a major slowdown, so much so that they think interest rates will have to be cut in the future. It's actually one of the most reliable predictors of an upcoming recession we have.
So at the end of the day, that's why people treat the yield curve like a crystal ball. It really is a snapshot of the market's collective wisdom, or its collective guess, anyway, about where the economy, inflation, and interest rates are all headed down the road.
Okay, let's put it all together. The interest rate you pay on a loan isn't just some random number pulled out of thin air. It starts with a base price, set by the simple supply and demand for money. Then you add a layer on top for what you expect inflation to be. Then you add another layer to cover the risk. And the entire thing is shaped by what the market as a whole thinks is going to happen tomorrow. It's a complex code for sure, but it is a logical one.
This analysis is based on material from 10th Decile. So if any of this sparked more questions or you want to dive even deeper, feel free to reach out to Sachin Chawla. His email is right there on the screen.
And that just about does it. We have officially decoded the forces that shape so much of our financial world. So I'm going to leave you with a final thought. Now that you know the code, now that you can speak the language of interest rates, go take a look at the yield curve today. What story is it telling you about our economic future? Thanks so much for watching.